Hello and namaskar viewers. I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk with AJ, your favorite show right here on your favorite TV channel, that's ITV Gold. The show is proudly brought to you by Science CPS Services, a full-fledged professional accounting firm located in the state of New Jersey, multiple locations to assist you with any tax matters or any business-related matters. When I say business-related matters, I mean if you need virtual CEO, virtual CFO, if you need bookkeeping services for your business, if you need payroll services, that all can be done by Science CPS Services trained and knowledgeable staff. And their on-hand CPAs can also guide you in the right direction when it comes to taxes, personal taxes or corporate taxes. For more information, you can contact them by calling 908-888-8900 or visit sciencecpsservices.com. With that note, I'd like to welcome a gentleman who leads Science CPS Services to the greater heights of success each and every year because they believe in doing taxes and everything so right, and that is Mr. AJ Kumar, CPA and MBA with Science CPS Services. Sir, welcome to the show.
Thank you, Sanjay. Thank you for the kind introduction.
Sure, very well. Of course, you deserve it because everyone talks about Science CPS Services and how happy they are with the services they get at Science CPS Services. All right, so tax season is over, of course, and now we pick on a very interesting topics that might interest you. And if you have filed extension, then definitely you really need to know. When it comes to taxes, we know that income that you earned, you pay taxes. But let's talk about non-taxable income. What are the non-taxable income and how you should know about what you should know about those non-taxable income?
Absolutely, Sanjeevji. So we know any income that you have, W-2, salary, commission, bonus, anything, this is all taxable income. We add up the income and then we compute the taxes at the end of the year. But how about some income that is not taxed? How do you create income that you don't have to pay the taxes on? So today's topic is discussing income, what type of incomes we have that is not going to be taxed at the end of the year for you. Non-taxable income today. So let's start with gifting first.
Okay, absolutely.
So the gift limit for 2025 is $19,000 per person to per person. What it means is husband can give $19,000 to somebody, wife can give $19,000. So a couple can give $76,000, $19,000. Husband can give to husband can give to wife, and then wife can do the same thing. So $76,000, and you say, what form do I need to file? No reporting needed. Up to $19,000 of gift can be received with absolutely no tax implication and no reporting requirement. You say, what if the amount is higher than $19,000? How much tax do I have to pay if somebody is gifting me more than $19,000? Even then, there is no tax that you have to pay as a giftee. As somebody who is receiving the money, you have no obligation to file taxes or report that gift as income. The filing obligation belongs to giftor, the person who is giving the gift, and depending on their situation, even they may not have to pay any taxes. The point we are trying to make here, the first type of income that is not taxable is gift. If you are receiving the gift, you don't have to worry about it. How about the coupon cashed or discounts received? Absolutely no taxes. If you have a coupon or if you have some discounts, it's not reported, it's no filing needed, and it's not taxable income. You owe some medical expenses and somebody is paying your medical expenses on your behalf. There is no limit. You don't have to worry about $19,000 anymore. Medical expenses paid on your behalf does not create taxable income for you. Same thing for the tuition. You have school-going children, you have college-going children. The tuition fees is very expensive these days. And let's say the grandparents are paying the tuition directly to the school. How much can they pay? Everything, as much as they can afford. So the tuition paid directly to the school, similarly as medical expenses paid directly to the service provider, are not taxable. But take a step back. If they are paying this money to you and you are making this payment to school and or the hospital, then the limit is $19,000 per person to per person. But again, for a couple, To another couple, it could be multiplied by 4, 76,000, which is per person to per person limit. So there are a lot of other incomes that we have that are not taxed. So knowing what's taxable, what's not taxable is going to help you plan your taxes right.
Well, you gave some very useful information in that one. You started with the gift, then you continue with coupons and the discounts that you get, and the most importantly, medical expense.
Absolutely.
Can you just give a little more detail with specific on a medical expense, that how medical expense can be non-taxable?
Well, so if you are paying medical expenses from your pocket, you can claim it as deduction on itemized deduction, but the medical expenses have to be more than 7.5% of your AGI. You know your income is 100,000 and your medical expenses are 5,000. You're not going to get any benefit anyway. So if somebody else is paying that medical expense on your behalf, then they can claim this medical expense on their tax return and it's not taxable income to you. Let's far-fetched example. Let's create a hypothetical example. 4 families, each have $5,000 worth of expense, medical expenses, 100,000 of income. They each have to have $7,500 of medical expenses to claim. What if only one family pays $20,000 and create a gift to the other 3 people? We are trying to create a far-fetched example to see how the tax benefit can be received. The key here is medical expenses paid on your behalf does not create taxable income for you.
Okay, very interesting. So now, after that category, let's move on to inheritance. How does inheritance fall into taxable income or non-taxable income?
Absolutely, Sanjeev ji. So right now, the inheritance limit is almost 14 million, 13.99 million per person. So if you have a couple, husband, wife, they can give to the next generation up to $28 million. If you have, let's say, one person, they never both passes away at the same time. Let's say if one person passes away earlier, you can always do Form 706 filing. We call it portability filing. So the remaining limit of the person who passed away, their remaining gift limit can be moved to the survivor. So in a couple, up to $28 million can be given to the next generation, or however they choose, at no tax consequences. Meaning the person who is receiving it, let's say if you got $10 million, once you start earning interest on that $10 million, that interest is taxable. But the $10 million that you received as inheritance does not create taxable income for you.
Okay, that's very interesting, folks. We're talking about non-taxable income in this week's show, The Tax Talk with AJ, brought to you by Science CPS Services. Life insurance proceeds.
Life insurance proceeds typically are not taxable. There are extreme situations where they may be taxable, but generally speaking, life insurance for somebody, just because the premium that you are making, the premium that you are paying to the insurance company is not tax deductible for you. So when the insurance is exercised, the proceed from the life insurance is typically not taxable. There is a plan where you buy the insurance for each other, meaning let's say there are 2 partners in a business, and they buy the insurance on each other just because the business is going to suffer. Business cannot survive if one of the partner happens to pass away. And the premium is paid through the business and is claimed as an expense in that business. In that case, the beneficiary is business. In that special case, the life insurance proceed may be taxable, but in most cases, when the life insurance proceed comes to the taxpayer, they are generally speaking not taxable income.
Okay, that's well, everybody knew that life insurance proceeds are non-taxable, but a little more information in that category definitely helpful. How about rollover from Roth IRA?
So great question. So rollover means you're rolling over one type of retirement account to another type of retirement account. So when you have your traditional IRA, where you took the tax advantage at the time of contribution, when you roll your traditional IRA into Roth IRA, that creates taxable income. But for Roth IRA, if the contribution happened to be in Roth IRA to begin with, you did not take the tax advantage at the time of contribution. So roll over from Roth IRA account to any other retirement plan is going to be a Roth plan, and it's not going to create any taxable income for the taxpayer.
Okay, so that is all very thing to make a note of it. So after life insurance and rollover from Roth IRA, does scholarship money come into this category by any chance?
So a scholarship is not taxable income for the person who is receiving it. And you can take an example. Let's say a lot of schools, especially when the tuition is so high in these days, a lot of schools have this scholarship. If you maintain certain grade, if you maintain certain scores, you get certain scholarship, or at the time of admission, just to entice the brightest student. A lot of schools come up with a plan that regular tuition is $50,000. But because you have this much grade, this much performance, you get 10,000 of a scholarship and you only pay 40,000. So this 10,000 is not taxable income for the taxpayer.
Okay, very well. That's really good to know. All right, folks, you're watching the show, The Tax Talk with AJ, right here on ITV Gold. The show is brought to you by Science CPS Services. Science CPS Services for all your accounting and the tax matters need. Tax season is over, but tax season is never over because there is always something to do. People who file the extensions, people who are starting their business and, quarterly tax returns and whatnot, if you're just self-employed. So there are several things. So tax season is always on, and that's why Science CPS Services, they have their knowledgeable, qualified CPS on hand to guide you in the right direction. Besides, if you are, just in case, are in a IRS tax audit, and if they have sent you a letter, if that's a legitimate letter that you need to verify, and then you are wondering what to do, then immediately my suggestion to you is that contact Science CPS Services. They will help you with that IRS tax audit matter. Once again, they can be reached at 908-888-8900 or visit their website, sciencecpsservices.com. With the short break, we'll be back after this messages. Stay with us. Welcome back to the second half of the Tax Talk with AJ. This weekly tax show gives you all the updates and information that you really need to know when it comes to taxes. And again, taxes, personal or corporate taxes. Today's topic is non-taxable income. Right before the break, AJ told us about certain categories in non-taxable income. We started with the gift. Once a person receives a gift, what happens? Then inheritance, and then rollover from Roth IRA. So these are the things that we covered in the first half, and the other things. Now we're going to continue, and also we talked about scholarship. Now we're going to continue with the more things in this second half. Let's start with the child support payments. Are they taxable?
Well, no. Child support and child alimony. There were two things. And after 2019, the tax deduction for the child alimony has been removed. Child support was never taxable. Never tax deductible for the giver, never taxable income for the receiver. Child alimony used to be, and it still is. If your divorce decree happened prior to 2019, you may still have the same clause. But now, with the new divorce, child alimony is not tax deductible for the giver and is not taxable income for the receiver. Child support was never taxable income for the person who is receiving it.
Okay. So that's one thing clear. Why did they change the rule after 2019?
I'm glad you asked. So if you think about it, the way the divorce decree works, the person who is making more money is supposed to give money to the person who is getting less money, who is making less money. So when you make a child alimony deductible for the person who is making more money, they are typically in the higher income tax bracket. So let's say if one spouse is making 200,000, the other spouse is making 20,000. Typically in a divorce decree, the person who is making 200,000 will give money to the person who is making $20,000. But this person who is making 200,000 is in a much higher income tax bracket than the person who is getting 20,000. So even though you give tax benefit here and make it taxable here, it creates a tax arbitrage. Government ends up losing a lot of money because they're giving the tax benefit to the person who is in a higher income tax bracket and trying to charge the taxes to the person who's in a lower income tax bracket. So after much discussion, it went back and forth for a lot of time. About a few years ago, they decided we will not give the tax break to the person. It's sort of punitive. I mean, if you are making money and you are going through the divorce, going forward, you don't get the tax benefit for it. The person who is receiving the money is not going to be paying any taxes. But if you take a step back, the court system, the way they used to decide these amounts as how much money this person should be paying to this person, they used to factor the taxes. Let's say your expenses are $1,000 a month. your tax bracket is 20%, so you should be paying Mr. $1,200 to her in this example, because they're factoring the tax component. Now, in the new divorces, just because the tax component is not there, that amount has automatically been reduced to $1,000.
Okay, all right. I thought you would just say the reason they made this change after 2019 is just to let people know that it's not good to be divorced and it's not good to having a liability of child support.
That's there too, absolutely.
All right, moving on to the show, non-taxable income categories. That's what we are discussing. Now, what about long-term insurance payment? You know, some seniors...
Long-term care insurance are
Long-term
not
care.
supposed to be taxable income for the receiver. There are mainly two reasons for it. If you take a step back, first, the long-term care insurance premium, the amount of money you are paying for the insurance, is not tax deductible. And second, this long-term care insurance is typically paid to the healthcare provider directly. So there are two parts to it. First, technically speaking, it's not the money that's coming to you. It's going to somebody who's providing the healthcare. And second, the premium that you are paying, we did not give you the tax benefit for that deduction. So typically, long-term care proceeds are not taxable income to the taxpayer.
Okay, good to know. Health savings account. Many insurance companies, you know, they offer this option called HSA, health savings account.
So the way the HSA works, some part of your taxable income is taken from you. You submit some sort of receipt, and the amount you receive is sort of a reimbursement against the expenses, against the healthcare expenses. It could be any sort of FSA, any sort of flexible spending account. It could be healthcare spending account, it could be childcare spending account. So the amount that you're receiving is by submitting certain receipts, certain proof as an expense reimbursement. You have already incurred that expense. So it's not considered as taxable income because by definition, it's not the money that you're receiving, it's the reimbursement. You incur the expense first, you give us the proof, and then we give you the money.
Okay, very well. Let's talk about veterans' benefits. Are they taxable?
Typically not. Veteran benefits are typically not taxable. So that's the key here. A lot of people try to do their own taxes and not knowing what income is taxable, what income is not taxable. A lot of people end up including the income that's not taxable. The way the IRS system is designed, IRS software is designed, if you tell that I had X amount of income, I had $10,000 of income, the system is not going to verify if your income is 10,000 or 8,000. If your reported income is more than the income that IRS believes you had, the system is not going to come back to you and say, hey, you reported more income, you paid us more taxes, here is your money back. That's not how the software is designed. If you report less income, let's say if the system, your W-2 or 1099 is reported at 10,000, but you report only 8,000, you will definitely get a notice that you under-reporting income notice, we call it. You will definitely get a notice that you reported less income than what we believe you had. That's why you owe us more money, more taxes. But if you report more income, then nobody's coming back to you. That's why it's important for you to understand what income is taxable, what income is not taxable. So you don't report non-taxable income as taxable income.
And that's why you need a very good professional tax accountant, which AJ and his firm, Science CPA Services, can guide you in the right direction. So anywhere you're confused about this taxable income, non-taxable income, whatever it is, and if any one of these categories that we talked in our show affects you, then definitely you need to contact Science CPA Services. All right, quickly, one more thing before we go into some of the questions that I have. If a couple wants to adopt a child and whatever expenses they incur during their process to adopt a child, is it taxable, that expense, or non-taxable?
So any money that you receive for child adoption is typically not taxable income. So again, just be careful. Just make sure you understand what constitutes taxable income and what's non-taxable. Typically speaking, the child support is not taxable income to the receiver. Child adoption related reimbursements, we call it, are not taxable income either.
Okay, very well. Now, I just have some questions, after listening to you.
Please.
With all these categories and everything. What exactly is tax-exempt income? Which is different than non-taxable, right?
It's similar, different but similar. The concept is tax exempt is exempted from taxes. So there are different type of income you have. There are 10 different type of income you have. You have salary, W-2 we call it. You have commission. You have bonus. You have business profit. And a lot of times, 9 out of 10 times you find yourself, oh, this is taxable. Of course it's taxable. Then how do you define what is exempt from the taxes? So tax exemption means what income is non-taxable for us. What income is exempt from the taxable situation.
Okay. So now, when someone looks at W-2 at the end of the year, how can they figure it out what is taxable income out of W-2 and what is non-taxable?
Well, box number 1 represents your taxable portion. So if you look at a typical W-2, box number 1 has taxable income, box number 2 has federal income tax withholding, then box number 3 has the social security, then box number 4 will have social security amount, box number 5 will have Medicare amount. So typically the difference between box number 5 versus box number 1 is your non-taxable income. The question is on W-2, how do I know how much income is taxed for me? And that's box number 1. How much tax you have paid? That's box number 2 here.
Okay, all right, simple as that. My question to you is once you have all this taxable income and then a non-taxable income, right? Do tax exempt income affect your AGI, adjustable gross income?
No. Typically not. Adjusted gross income is a formula which is based on the total income minus certain deductions. Your AGI does not include the tax exempt income.
Okay, so that's good to know. At least your AGI is not affected. All right. Anything else? We talked about welfare benefits. We talked about veteran benefits. Now, all these things that you mentioned when it comes to non-taxable income, is it same for the state level also? Because I think mostly what we discussed was on a federal level, correct?
In most cases, the same income is going to be tax-free at the state level as well. So just be careful. There are some exceptions to the rule. But generally speaking, and you're right, Sanjeev ji, whenever we talk about taxes, we are talking about IRS. Rarely do we include certain mentions of the state. And because there is one federal government, there are 50 different states. So when you start talking about the state, which state do you want me to talk about? I mean, sales tax. New Jersey has 6.625%. In Newark, just in New Jersey, there is a different area where the sales tax is half, not the regular sales tax. New York has 3 different type of sales tax. Same thing with the income. New York City has a different additional income tax. So not only talking about a state is more cumbersome just because you have multiple states. The other problem is, or the other side of the equation is, typically the IRS taxes are 3 to 4 times higher than the state taxes. IRS taxes could be as much as 37%. The state tax maximum is 9%. So when you're looking at the taxes, you are only looking at the bigger piece, the central piece. But a lot of these rules that we talk about for IRS tax exemption typically applies to the state as well.
Okay, very well. Last question, quickly. Is there any IRS publication that we can refer to find out what exactly is taxable income and what is non-taxable income?
Absolutely, Sanjeev ji, absolutely. So if you want to learn more about non-taxable income, tax-exempt income, please refer IRS publication 525. You can just type on Google, on internet, IRS publication 525, 525. You'll get a PDF file, very easy to read, and it will detail out, at least at a summary level, give you what income is non-taxable or tax-exempt income.
Okay, very well, AJ. Thank you so very much for your time. Thank you for your valuable input, as always, and in today's discussion, non-taxable income in our show, The Tax Talk with AJ. Until we meet again, same place, same time, I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.
Thank you.